Bonds. A lot of people have bonds. I think that bonds are an interesting animal because most people don't understand them, yet they have a significant portion of their portfolio on them. So let's talk a little bit about bonds. This is the core fixed income. So there's different types of bonds. There's super aggressive bonds, there's super conservative bonds, there's government, there's corporate, there's bank loan. There's a couple dozen different types of bonds. So these are just core, meaning they're big companies that have borrowed money. When you sell bond, you borrow money, you pay interest on it, and eventually you pay it back, right? That's when the bond matures. So these are the maximum drawdown, meaning the amount of money that you lost in any given month in the orange, which is the stock market, right? The S&P, and the blue, which is in bonds. As you can see, stock market has several, almost 30% drops, well, a couple, I should say. They've got a bunch of 15 to 20% drops. And this doesn't go, this is the 90s. The 90s was the best decade in the history of the stock market. So you have some pretty substantial drops, but look at bonds. What is this? Down 2%, down 3.5 or 4. The biggest drop was right here, was for 1 month. You were down 6 or 7 while the market was down. This says 30, but that's 1 month. Over 2 months it was down 40. Bonds are very conservative. The problem with bonds and why we tried to stay away from them in the last couple of years, to the extent that we can, is as interest rates go up, the existing bonds that you own go down a little. Now, again, you can see by this blue line, it's not a lot, but it's a little. The problem is interest rates are so low, the interest that you're earning on those bonds is small. So if interest rates go up a little bit and you lose 2% in your bond portfolio that year, you might have just lost all of your interest and now you've made no money. And that's what we're worried about in bonds. How we use them is as a rebalancing tool and as a principal protection tool. So we know you're not going to lose a lot of money. You can see here, and you could go back, you could do this back for another 30 or 40 years and you would see the same thing. They're conservative and you're not going to lose a lot in bonds. Whereas in the stock market, as you can see, you got way, way, way bigger swings, but of course, a lot more upside over time. So if you are later in life and you can't outlive a big recession, you own probably quite a few bonds. But even people like I own, 20% of my portfolio is in bonds, right? Because I rebalance into it and then out of it. So as the market goes down, right, I sell stock and I move it to bonds. As the stock market goes up, I sell stock and buy bonds. As the stock market comes down, I take some of those bonds and I buy stock. And I've done that for years and years. We do that. We believe strongly in that. We do that for our clients as well. So that's kind of how we're using bonds. Are bonds expensive, and should you expect to make a lot in them? I think yes. I think that they are very, very expensive. And I think, no, we're not going to make much. But in case we're not in that Goldilocks zone, what we're going to do is what we've always done. We're going to own some bonds. We're going to sell stock when the market's high and buy even a few more. And then when and if the market goes down, if we're not in that Goldilocks zone, just like we did in COVID, when that market was down, within a week of the exact bottom of the market, we rebalanced client portfolios. And in some cases, we were taking almost half of the bonds and dumping them into the stock market within a week of the exact bottom. That's an effective way to do it. If we end up with a big recession and the stock market goes down, you will have built up a lot of these bonds and we'll pile them right back into the market when when those shares are cheap. So that's how we're using bonds. So again, we're not super excited about them. We've been using them less than we have in the past, but we still, people still own them and they should. With that, let's see how I did on time. Okay, we started 5 minutes late, so we went 25 minutes. That's not too bad. All right, everyone. Well, thank you very much for the time. I really appreciate it. I'm glad that we were able to keep it a little bit shorter today and get you on with your day. So thanks again, and have a great day.